There we go. Okay, so I'm Jennifer, founder of Space Coast Crypto Consulting. So I'm here on the Space Coast of Florida. So I work with retail and financial advisors on how to buy, sell, and store digital assets safely. I have also developed a 6-week crypto accelerator program that's designed to bring you from novice to knowledgeable in the crypto space. So this kind of goes through the basics, the beginning from what is blockchain technology to how to buy your first crypto, and then also explore different options as far as generating multiple streams of income from your crypto assets. So you can, have buy and hold strategy and then trading strategies, and then also ways that you can cash flow. So you can have multiple streams of income from your crypto assets. I also work with businesses and do personal one-on-one consulting, and then how to accept crypto as payment. So joining me here today, I have Josh Sands. He is the crypto tax man and the expert in the space. So he's going to go over some things as far as your crypto taxes and what are considered taxable events and some common issues that come up, and the process that you can take to make sure that you are doing your taxes properly. There's 2 things in life that are guaranteed, and that is paying taxes and death. So we want to make sure that we're paying our taxes and being contributive citizens. I'd like to say if you're not paying taxes, you're not making money. So here is details of the crypto accelerator program that I offer. So like I mentioned, that going through basics and how to set up wallets and hand-in-hand guidance, and a little friendly reminder for today. For the past week or so, the market has not been doing so well, really just playing off of some negative news in the crypto market, trying to front run the Fed and talking about interest rates. So I keep getting calls and texts and the sky is falling. What should I do? So not financial advice, but keep hodling. I will go ahead and pass on the screen share to Josh, and I'll let him introduce himself. All right, so I'll stop this share, and then you should be good to go ahead.
I'll share. My name is Joshua Sands. My crypto tax prep business is called Crypto Taxman. And today I'm just going to go over kind of some of the basics. If you want to do it yourself, or if you're looking to hire someone, but either way, it should be pretty informational to kind of give you a start on what to look for, what to do when it comes to preparing your own crypto tax forms. So this is basically what I'm going to cover today. So a little bit about my background, then cost basis reporting, the current tax rates for 2022, the reporting methods and taxable events, or what are taxable events. Now, I'll go over kind of what my process is, and then basically what the goals of your crypto tax prep should be, common issues that I come across, and then the tax forms that are used. And I have seen some questions come in. I think we're going to wait till the end for Q&A. So a little bit about myself. My actual background is in wealth management and financial planning. I started back in 2008, basically when the sky was falling then. And then back then, I did a lot of cost basis reporting, actually to earn extra cash when I started in the industry, which is kind of what we're doing now with crypto. But it wasn't until 2017 that I began investing myself in crypto. And then I also had clients coming to me asking me, am I going to have to pay tax on this stuff? I couldn't advise on, buying different types of crypto, but I could help with the crypto tax preparation. And that's when I kind of discovered that's my way to get my feet wet in the crypto space, while also being in the traditional finance world, which I'm still in both now. So I have two financial practices. It wasn't until 2018 that I actually partnered with a national tax firm and really the agreement there was that I was going to help them with their crypto tax clients, and there would be some type of referral, relationship. It didn't really work out that way. So I ended up leaving them in 2019, and a lot of their clients actually came with me, and that's when I started Crypto Taxman, and that's ever since then, that's what I've been doing on the crypto space. But so prior to 2011, cost-basis reporting, it was left up to the investor to report their own cost basis. That's exactly what we're going through right now with crypto. The only difference is your stock trading then and now is still isolated to a certain, a specific exchange. In 2011, the IRS started requiring that broker dealers start issuing 1099Bs, or just, there's other types of 1099s, but 1099s to start recording cost basis for investors. Now, crypto companies are attempting, or crypto exchanges are attempting to do that now. The first that was starting to do that was Coinbase, but they were issuing 1099Ks, it was just a complete mess, because 1099Ks are for businesses that process credit cards, and it reports gross proceeds from basically sales. And people were getting 1099Ks that were, it would show that they owed like $1 million or $2 million from the IRS, and it just wasn't correct. So now crypto companies are issuing 1099 miscellaneous forms. I heard Cash App is issuing 1099Bs, which would be the proper form, but I don't know how they're doing that, because if you transfer your crypto, the cost basis, may not be, you're not gonna be able to match up proceeds and cost, or proceeds with cost basis. So we're kind of living the environment we had prior to 2011, where it's up to you as the investor to, if you want to properly, pay the proper amount of taxes, it's up to you to basically report your crypto trading activity. So it's going to take time. I don't even know if it's possible for exchanges to properly report the 1099, but we'll see what happens, because the main issue is it's just very easy to transfer your crypto from one exchange to another. So your cost basis really can't be tracked across all of those. It's really hard unless you do it yourself. Here are just the basic tax rates. So if you're not familiar with short and long-term rates, short-term rates are equivalent to what your income rates are. So it ranges from 10% to 37%. Plus, if you live in a state that has, state tax, you'll be subject to that as well. In regards to long-term, so short-term is if you hold really any type of security or crypto under 365 days. If you've bought it and you held it for more than 365 days, you do have the option to or take advantage of long-term rates, which are much lower. So if you have the nerves to be able to hold on to your crypto through the ups and downs and take advantage of long-term rates, it's usually very beneficial for those states where their tax rates are extremely high, like California, New York, New Jersey. Here in Florida, we're lucky we don't have state taxes too. So it's definitely something to think about if you're in one of those states too. It's always good to have a core holding of your portfolio to that maybe you can have subject to long-term rates. So reporting methods that are typically used. If you're not familiar with reporting methods, you'll see FIFO, LIFO, highest price first out, specific ID. So FIFO is first in, first out. LIFO is last in, first out. The next one is highest price first out, and then specific ID is being specific on the tax lots that you're going to use. So example, actually I have an example on the next slide. So I thought I did. Okay, maybe I missed this one, but just an example of a FIFO method. Let's say we buy 1 Bitcoin in January of 2021, 1 Bitcoin in February of 2021, and we sell 1 Bitcoin in December. We're going to use that first tax lot in January as our cost basis. So if we bought it for $1,000 in January, we sold it for $5,000 in December, we're going to have a gain of $4,000. LIFO would be that second tax lot. That was the last one that you bought in February. Highest price first out, you're going to use the highest price that was purchased throughout your trade history in that year, or it could be from a previous year as well. And then specific ID, you can choose any which tax lot that you want or cost basis that you want. So in the guidance that the IRS put out in 2019 about which reporting method to use, they state that if you're not using specific ID, you need to use FIFO. But a little tip here, using specific ID is using any one of these methods. You can be specific. So I always tell people, if you're going to report the method you're using, not that you don't even really report the method you're using, but you can on the disclosure form, just state that you're using specific ID always. Moving on to taxable events. So this is probably one of the most common questions for people that are new to crypto tax, just in general. So crypto taxable. So if you're buying Bitcoin with another crypto, taxable. You're selling Bitcoin with another crypto, taxable. If you're selling your crypto to USD, crypto to USD is taxable. Bitcoin to USD taxable. Income, types of income that are taxable as income, which would be reported as other income on your 1040, would be mining, staking, rewards, airdrops, interest that may be received from Celsius or something. Those are all reported as income. Now, when you receive that as income, let's say you receive a little bit of, I don't know, let's say you're mining ETH, and you receive $100 worth of ETH. You'll report that $100 as income as received, and then your cost basis for future sales is set at that $100. So if you sell that later on, and this isn't double taxation, it's just taxed as a different type of tax rate. And if you sell that in a later date, you're going to be subject to short or long-term capital gains tax. So let's say you sell it, at $200 a year from now, you'll be subject to long-term tax rates, and you'll be taxed on that $100 from that point on. So if another taxable events are if you purchase goods or services, it's becoming more and more common that people are using their crypto to purchase real estate. That is a taxable event because you're essentially, disposing of that asset. So when you sell that asset, you're going to be using, whichever cost basis you happen to use to determine the tax that you will owe on that purchase. Interest, actually, that interest, liquidity pool interest that goes along with income, it's going to be reported the same way. And if you're a business receiving crypto as payment, yes, you're going to report that as revenue for your business, the amount that's received at that time. And again, after you receive that, the cost basis is set. If you plan on holding on to that asset going forward, you'll pay tax on the difference at short or long-term capital rates. Non-taxable events, transferring from wallet to wallet, non-taxable. If you're gifting, that is not taxable to you. You may have to file a gift tax return, but all that is really a disclosure to the IRS, because basically what they're going to do is deduct that amount from your lifetime exemption for estate purposes. But what really happens is the amount that you gifted, the cost basis, you'll choose a cost basis to transfer over whoever you're gifting that to, and they'll use that for their cost basis going forward. And then finally, USD to crypto. If you just got on Coinbase or somewhere to start crypto and you're spending US dollar to buy crypto, non-taxable. Oh, actually, here was my example before. I kind of had this out of order. Sorry about that. So I'll just go over it one more time. If we were using, FIFO, this is your first purchase here. And there's one sale, or there's two sales here actually. If you're using FIFO, you're going to use this tax lot and one of these that were bought. There was two bought in March. That's FIFO. If you're using LIFO, you're going to use this one here and one from this tax lot here. And specific ID, you're going to use any one you want, basically. And highest price first out. I didn't put any prices associated with these buys, but it's basically going to use the highest price from any one of the buys throughout the year. So process and really the goals of crypto tax preparation. So really first, I tell people, if you're going to do it yourself, and you want to make sure that you're capturing all your information, unless you have a very easy situation, get out a piece of paper, write down every exchange, wallet, anything that you've possibly used. So you have note of this. Make sure you can access those exchanges and wallets. Then you're going to find an accounting software that's going to help you basically, report your, generate those tax forms for you and help you with your balance reconciliation. That's really how you know you've done everything correctly. There's a lot of different software out there: cointracking.info, cointracker.io, bitcoin.tax, BitTax, ZenLedger. So choose one of these, and then each one of those pieces of software will give you instructions how to download your reports from your exchanges. Or you can actually set up API connections where it'll actually import that data, just read-only data from those exchanges. But the reason I say write everything down and make sure you have everything, especially if you've done a lot in the crypto space, is because if you don't, you're gonna come up with a lot of issues, and you're gonna end up having a taxable gain that's much higher than you normally would, because you're gonna be missing cost basis. Once you have all those reports and API keys and secrets generated, you're going to import those into the software. And really the goal, the way that you know you've done everything correctly is when you've imported everything into the software, and you run what's called a closing report for your year-end reports. It shows where your current balances are. Your current balances in the software should reconcile with what you actually have. That's when you know you've got everything in the system. If you don't, you're going to come up with issues. Like I said, if you're missing trades, you're going to have sales with no cost basis. So the system is going to report it as a zero cost basis. So you're reporting that full amount. So instead of having a cost basis of like $100 for maybe a coin, and you sell it for 200, they're gonna have it in the system as a zero cost basis. So you'll pay tax on $200 versus $100. So it's very important to make sure you have all your information in the system. That's one of the biggest issues that I see, that people have tried to do it themselves and then they come to me for help. So here's the common issues. Again, missing cost basis, number one by far. People come to me, they say that they owe like $100,000 or even sometimes $100 million, and it's just a simple issue of missing information in the system. Sometimes it does have to do with if it's like an exorbitantly high amount that it's saying that the coin is worth. It's just pulling in the wrong data, and just issue that needs to be fixed manually. If you've had coins that had ticker changes, that causes issues all the time. You'll see a missing cost basis because you sold, XYZ coin, but before it was ZYX coin, and they changed that ticker, and the system doesn't recognize it. Transactions mislabeled in the software. So now with DeFi, there's a ton of this going on, because a withdrawal, that could be you bridging assets to another chain, and the system doesn't recognize that. It just sees a withdrawal and then a deposit of another coin coming in. It doesn't recognize that. If you're actually bridging from one coin to another exchange, that actually would be a trade. Or if there's deposits coming in that's like staking, it'll just show deposit, and then you'll show sales of those assets, but you'll have no cost basis because it'll just be registered as a deposit. Balances don't reconcile, and this is one area that's getting more and more difficult to do, because the DeFi space there's so much going on, and people are doing so much things on the blockchain that the data that's coming in from your wallets, it's a lot. And sometimes it's really hard to get in it, 100% accurate balance reconciliation. But it can be done. It just takes some work. Duplicate trades, I'll see people, entering or uploading their files more than once on accident, and they'll get duplicate trades, creating issues. If you've done any margin tradings on futures options like on FTX, hopefully, FTX I think is starting to issue 1099-Bs just for margin trading. For spot trading, you still have to do that on your own. And then Forex airdrops, rewards, you got to make sure you label those properly, because we come up with missing cost basis for those. So the tax forms that you'll need. Any income received, again, staking, mining, whatever, you're going to use 1040 Schedule 1 and they'll be entered into other income. It's pretty straightforward. If you use your TurboTax, there'll be a section for other income. You just enter it in there, the US dollar equivalent of what you've received. The 8949 is kind of like the main form that you're going to have software generate for you. So this just basically reports, what your cost basis is, what your proceeds were when you bought the coin, when you sold the coin, and what the gain was for that particular sale. The 8938, this is the FBAR form. So if you've traded on, it's still questionable whether this is needed. There has been statements out there by the IRS saying that they do want you to report FBAR reporting, which is if you hold assets on an exchange where the balance exceeds $10,000 throughout the year, you'll have to just fill out form 8938, basically just stating that you held assets on these foreign exchanges. You don't owe any more tax. It's just a disclosure form. And then your 1040 Schedule D is basically everything from the 8949, which your final results for long and short-term gains will transfer over to your Schedule D. And if you have any losses from previous years, those will also be stated on Schedule D. Those losses get carried over until they're used up to future years. Now, once you're done doing the reconciliation and tax prep for your capital gains, there's always some planning that can be done for future tax years. First of all, you want to make sure that you cover all missing bases. Second, you reconcile your current coin balances. Really, the opportunity here is with harvesting. We haven't seen the wash sale rule go on, meaning that in the traditional securities world, there's what's called the wash sale rule, that you can't buy back. So if you're selling a coin for a loss, just to harvest the loss to offset your gains, you can't buy it back for another 30 days. That was supposed to go into effect January 1, but it did not get passed. So there's still that opportunity out there. If you have gains at the end of the year and you want to offset them, get rid of some of those junk coins that you bought a while back to offset those gains. And that's really the biggest planning area that I help with clients towards the end of the year. So we can go over some Q&A. If you want help with this area, you can always come, reach out to me. You can scan the QR code. That'll take you straight to my website. But if you have any questions at this point, we'll take, Jennifer, I don't know how much time you want to take to do questions. I've got a meeting that I got to prep for. I probably got to start, prepping in about 20 minutes. So I probably got 20 minutes for questions. I can't hear you.
Yeah, let's take some questions. If anybody has any questions, if you want to type them in the chat. Now I have a question. So you mentioned bridging assets. So when you are using DeFi protocols and you bridge or are wrapping an asset, is that considered a taxable event?
Okay, so yeah, I guess there's different types of bridging too, because I do have clients that'll bridge from like WBNB to WETH. That's definitely taxable. If you're wrapping ETH, okay, first off, there's no guidance on this first off. So this is just me using my best, not guess, but kind of industry knowledge to treat this properly. I don't think it's taxable because first off, you're not buying wrapped ETH with ETH to profit. You're buying it to trade on another exchange. The best real world example I can compare to this is if you're familiar with what's called ADRs, American Depository Receipts. If an international company wants to sell their common stock on an American exchange, they have to issue what's called an ADR. And it's a 1-to-1 issue. If you ever want to convert that back to the common shares, then it's a non-taxable event. The cost basis carries over. So I do not think that wrapping tokens is a taxable event. But again, there's no guidance on this. That's just my personal opinion.
Right. So lots of gray area. Yeah, there's definitely a lot of things to consider. So I could see how it can very easily get complicated. Now, I have a lot of people who come to me to execute certain things, and they have no idea that even just swapping from one asset to another is a taxable event. So with this trend of these like millennial investors and Robinhood traders and everything, I think that there's going to be a lot of repercussions to pay in the future because a lot of people don't realize that their transactions are taxable events.
And that's all my new clients is they just weren't aware. They may be new to the space. There's some people that are aware, they just completely ignore it. But that's up to them to face those consequences in the future. So I see, how is the tax treatment different when you invest in hedge fund? A hedge fund, like a crypto hedge fund? I'm not sure what the specifics of the question. So if you're giving them money to trade for you, normally hedge funds, some hedge funds will issue tax forms. It just depends on the hedge fund. If not, then they're going to have to give you a trade history. But I would assume that most of them would issue a tax form for you. Yeah, because most of the people I deal with don't come to me if they're using a hedge fund, because they've had the tax reporting done for them.
Okay, I have another question. So you mentioned purchasing goods or services. So
Mhm.
we'll just use, for example, I believe last week Airbnb came out and said that they were going to be considering accepting crypto payments to, have Airbnbs reserved. So if I was to pay with my Bitcoin for Airbnb, that is a taxable event, and then they are also still charging sales tax. Is that right? So is that considered a taxable event if it's just going from
Well, it's a taxable,
to another?
yes. So the gross amount that you've used for that will be considered a sale, essentially, of your asset. That's how it's treated, basically. It'll show up in your 8949 as a sale of asset.
Okay.
And whichever cost basis, is used for that will be applied. So yeah, that's the only problem with people using, I think that's part of the reason why people won't pay me in crypto, is because it is taxable.
Okay. Yeah. So it may be better still not to use crypto assets for purchases because
Unless it's, USDC or something. But it's up to the person too. They could pay with a coin that's down to claim a loss on it. I would suggest that, but a lot of people don't want to sell their coins or use their coins that are up.
loss. Yeah. So also when you're dealing with exchanges that are not in the US, those exchanges are not required to provide that 1099-B. So I know some of the new requirements is that all exchanges that are in the US are supposed to be furnishing those documents.
Yeah, this is the first year where we're seeing like almost every exchange issuing some type of 1099. Like I said, Square is the only one I know of now that's doing an actual 1099-B, and I don't know how that's going to work. But foreign exchanges, no. And even if you do get a 1099 from these exchanges, really you should be probably filing a disclosure form with your taxes, just to let them know I've traded on X amount of exchanges, and the 1099s that were issued were for those specific exchanges, then they're not going to apply. And then you report your own proceeds and cost basis. That's how it's worked with every other exchange in the past, such as Coinbase issuing their 1099s. They weren't accurate, and you just had to basically report your trades yourself. Because most 1099-Bs you don't have to do anything really. It's reported to the IRS. But none of these 1099s that are coming out are accurate. And a lot of the new ones, like Kraken's issuing 1099 miscellaneous forms, it's just for income that was received for like staking. So that doesn't obviously cover your trading activity. Here we go. What mechanisms can you use to avoid paying taxes on every transaction? Well, trust still pay tax. Retirement accounts will defer taxes on trades. So that's probably the best type of account to use to defer taxes. You'd have to go out to a company that that specializes in self-directed retirement accounts. There's plenty out there. But yeah, you can, if you're a small business owner, you can use a solo 401k. Individuals can use IRAs. Sorry, my dog's barking. You can use IRAs, Roth IRAs. So that's probably your best way to avoid taxes and defer, because it's a legit way to do it, because anything that goes in a retirement account is tax deferred. Your IRA will be taxable when you pull the money out, but your Roth will be completely tax-free, tax deferred and tax-free or tax-free when you withdraw those funds.
And with those Roth IRAs and IRAs, are you able to get direct exposure to cryptocurrency, or is it utilized?
Yeah, there's companies out there. IRA Financial, I mean, there's a bunch. If you look up self-directed IRAs, there's a bunch out there that do it. I just know, for example, IRA Financial, they do kind of the record keeping for you. Your account's actually held at Gemini, so you can trade at Gemini, and then they will, if you want to transfer those assets out to like a wallet, they have to do it for you, because they're probably keeping track of where these assets are going. Because one thing you do not want to run into is commingling retirement funds with personal funds and trading crypto. It's just it's a huge mess, and you could lose your tax advantages if you get caught doing that.
Okay. All right, great. Well, a lot of really great information covered. I can see how things can get really messy and ugly quickly. So it would definitely benefit to have a crypto tax expert to help to prepare all of this for you. So if anybody has any further questions, and then feel free to reach out to the Crypto Tax Man. There's his contact information on the screen there. But I think that's it. So thank you so much for joining. Thanks for doing this, Josh. I appreciate it.
Thanks for having me.
Yeah, absolutely. All right. Okay, so we're all done. If anybody has any questions that they want to ask me. Yeah, CJ, if you want to put your email address into the chat there, and I will be happy to send you a recording.